that we saw. So I think it's a sustainable decline in the markets, and I would just rather be cautious. But it's a great time to go to cash so you can upgrade your portfolio and take the mistakes you may have made in the past. Say, you know what, I'm going to more of a sound investment strategy rather than chasing these so-called unicorns, which don't exist at this point.
Let's get the technicals of the market. Bring in Jonathan Krinsky, Chief Market Technician at BTIG. Jonathan, what levels are you looking at this point?
Yeah, so thanks, Melissa. We've been, targeting a sub 4,000 S&P for the last few months, so we're pretty close there. I think, the odds that it just hits 4,000 exactly and bounces off are pretty low. So below that, 3,900 really represents kind of a big area of volume-based support. Most people look at volume on a day-to-day time basis, but if you were to look at it on a price level basis, how much volume trades at each given price level, there's a lot of history at 3,900. So that's kind of been an area below 4,000 that we've been eyeing.
Okay, so 3,900. Obviously, Jonathan, there are sectors that have been in deep correction mode for much longer than the overall indices. So do you see any subsectors that may have maybe closer to a bottoming out process than maybe the broader indices?
Well, typically how corrections unfold is you have some early weak areas of the market, and this cycle it's been some of those high growth tech names. And then eventually as the correction rolls on, more and more sectors succumb. And I think what the mistake people make is they try too early to buy the weak sectors. And so it's unlikely that those weak sectors of the market are going to bottom before, the generals or the defensives kind of finally roll over. And I think we saw a little bit of that last week. We're seeing a little bit today with energy getting hit, but you still have, people rotating into consumer staples today. And so ultimately, I think it's a little too early to bottom fish in those beaten down sectors until you finally see those defensive holdouts roll over.
It sounds like that you think that there's very little to bottom fish at this point. I mean, if the markets are going to go to 3,900 or around there, are you basically saying wait?
Yeah, I mean, look, if we knew exactly the markets would go to 3,900 and bottom, then you could make the case that maybe some of those beaten down areas are starting to get interesting, but we don't know that. We think that 3,900 will be a decent target, but until we actually get there, until we see some of the capitulatory signals, and to be clear, we're seeing early signs of them today. Some things that we've been waiting for. Your previous guest mentioned percentage of stocks above the 200-day, so we're getting closer, but again, it's a little hard to predict what's going to happen once we get there until we actually get there.
All right, Jonathan, great to speak with you. Thanks for the levels. Appreciate it. Jonathan Krinsky of BTIG. We should note that the markets are pairing their losses right now. The S&P 500 is now down by 1.89%. When we started the show, it was down more than 2%. Bryn, you mentioned the percentage of stocks below the 200-day moving average. So I'm wondering what you would go first to bottom fish. Would it be technology, areas in technology?
So where I would start, well, first of all, I would wait till it gets below that. I think there's a really great stat. Bespoke had a great stat that I want to say about 50% of the Nasdaq composite is down 50% or more. And to give some perspective, there's about 2,500 names in the Nasdaq. So it's about 1,250 names are down 50% or more. And a lot of them will just stay down and languish. And I do think you have to get out your 2000, 2002 playbook, because clearly there was some speculation and a bubble that burst last year with all the Fed liquidity. And to Steve's point, when the Nasdaq hit its highs in 2000, it actually didn't breach those highs again or surpass them until 2015. But there was a long journey where you could have made a lot of money. And so I'm actually looking, I think it's early, I would actually be looking in some of the high quality tech names. It's interesting, Apple and Microsoft are still holding up really well. So I think to see real capitulation in the Nasdaq, you would need to see those names sell off. But ultimately, what's going to cure inflation and what's going to cure the supply chains, all these things that the Fed has no control, no control over any of this, is technology. And so although we're positioned very defensively, have a lot of covered calls, small cap value, things that we'll say are more protective, we still have the Qs, which are underweight, but longer term, as this overshoots on the downside, I want to go back into tech because I do think the Fed has a limit on how much they can raise rates. And I don't think they get Fed funds above, I would bet they don't get it above 2 until they have to stop. And then all of a sudden, everyone's going to start digging through and looking at these tech names and coming back them. So they're out now, but they are not down forever.
Joe?
So I just kind of want to collectively respond to everything that I've heard so far, and I appreciate everyone, Bryn, Courtney, and Steve's comments. But I guess what I'm trying to advocate for here, Melissa, and I think this is important, is the greatest athletes in the world will tell you in the most extreme pressure situations, they slow the game down, and that's how you succeed. I'm acknowledging exactly what Steven said. I already said at the top of the show, the macro environment, that picture doesn't clear up anytime soon. But there has been a lot of risk that has been pared back within the market. And if you have an investor who's sitting watching us right now, I think it's important to first understand, remain calm, don't panic, study the portfolio. What's in your portfolio? If in your portfolio you have Peloton, you have Teladoc, you have Roblox, you have Shopify, you have DocuSign, guess what? You have to do something. Those businesses, they need capital to fund their operations. They're going to be a challenged environment. So you have to take action there. But if you're willing to buy a Walmart or a Merck or a United Health or an Amgen, those are the type of companies that you want to be buying right here. And I'm also introducing the concept of buybacks this week because I think that's important to understand. I don't want you selling out of stocks where companies are going to be coming in this week and buying back aggressively. So it's not a call if this is the market bottom. No one knows if this is the market bottom, just like no one told you it was a market top in January. It's just kind of understanding the environment and having a degree of calm and then reflecting exactly what you have in your portfolio and say, okay, how much risk do I want to carry as we move forward given this environment? And if you're comfortable with it, stay where you are. If you're not, you've got to pare it back.
Coming up, cryptos continue to get crushed. Bitcoin hitting a 3-month low. Ether also falling. Insights in the trade from the committee is next. Halftime's back in 2 minutes.